Assalamualaikum and a very good morning to our Board of Director Dr. Kamila Hanim binti Kamil and to my other senior staff. Okay, as we know, today me, Ameerul Syaqiq Qushairy, we will and my other team would like to present our financial ratio analysis from two companies, which is QL Resources Berhad and DRB-HICOM Berhad. Okay, we cannot always assure the future of our friends, but we have a better chance of assuring our future if we remember who our friends are. From Henry A. Kissinger. So from this quote, we can see that it is important to choose our alliance wisely to secure our company to have a bright future and remain successful. We know there are two companies that we choose to be compared, which is QL Resources Berhad and DRB-HICOM Berhad. So QL Resources Berhad is a company that a sustainable and scalable multinational agro-food corporation, while DRB-HICOM Berhad is involved in the automotive manufacturing and assembling and distribution industry. First of all, we would like to go through DRB-HICOM Berhad. So what is DRB and what is HICOM? So DRB stands for Diversified Resources Berhad, while HICOM stands for Heavy Industry Corporation of Malaysia. So it was the biggest conglomerate in Malaysia and it started since 1996, and now it has almost 70 operating companies and also have 15,000 workers. And they also have built the DRB-HICOM University of Automotive Malaysia in Pekan, Pahang. So this company operates three segments, which is automotive, services and asset, services or asset, and also property. Okay, for the automotive segment, it is the only corporation in the country that involved in the entire of automotive ecosystem. It is also produce private commercial vehicle, motorcycle and defense vehicle. They also have strategic partnership with Geely Holding, which is Proton, that has launched its first SUV X70 and has break its sales record from this product. Interesting fact about this segment, they also have increased in their revenue, which is 6.7% from 6.9 billion to 7.4 billion. This operate segment give a good impact for their sale of their company. Okay, next we go to the services or asset and construction segment. So first of all, they have end-to-end logistic services under Post Malaysia Berhad Group. Second, they also involved in postal and logistics services, waste management and vehicle inspection. And the services recorded that 2% increases from their revenue due to the better performance by Bank Mohamad, Alafora and Puspacom. Okay. For the last business performance of the DRB-HICOM, which is property segment. So they are development primarily under the Glenberry name. Their current projects include Proton City in Perak, residential properties in Johor and Media City in Kuala Lumpur. And the last one, 37.7% dip in revenue, primarily due to progressive completion of two construction projects that has been undertaken, and which is Media City in Kuala Lumpur and the immigration, custom, quarantine and the security ICQS complex at the Thai border. Next company, which is QL Resources Berhad. It is established by Dr. Chan Sung Kun. A little bit background about Dr. Chan Sung Kun is a former mathematics lecturer, and then he joined family business, which is QL Resources Berhad. It is started in the year 1987, and it is the Southeast Asia largest egg producer and ceramic pro producer. It is involved as a leading agro-food corporation provider. QL Resources is a diversified resources and agriculture community with three core operations, which is integrated livestock farming ILF, marine product manufacturing MPM, and palm oil activities POA. First we go to the palm oil activities. So QL Resources involved in plantation, crude palm oil mining and clean biomass energy. However, the group expected the performance of its palm oil activities to be weakened this year due to the soft crude palm oil prices, unfavorable weather condition and lower palm oil extraction rate. Next, Agro-Food, whose net profit for first financial quarter climbed 15.3% year-on-year. This give a good impact to the sale of the company, and the growth is expected to be driven by its marine product manufacturing. From marine product manufacturing, they also opened convenience store, which is known as Family Mart, that has gained more attention from investors and the consumer. The last business performance of QL Resources Berhad, which is integrated livestock farming. So the diversified strategy into the regional market has helped to face weather challenges, and the group is natural on the ILF business in the domestic market. The group allocate 400 million for the capital expenditure in the fiscal year of 2020 to fund setting up of more chicken farms and boost their marine product manufacturing. They also plan to double up the Family Mart convenience store from 125 store to 170 store. Okay, that's all a little bit introduction about DRB-HICOM Berhad and QL Resources Berhad that give advantages to their own business performance.
Let's proceed to the analysis financial ratio to know the trend company's financial performance. For analysis financial ratio, we start with profitability ratios. QL Resources gross profit margin is 19%. This means that for every money QL Resources generated in sales, the company generated 19 cents in gross profit before other business expenses were paid. To be compared with the DRB-HICOM, their gross profit margin is 18%. It shows that QL Resources have the highest ratio, which will indicate that the company is selling inventory for a higher profit. Net profit margin for QL Resources after tax is 6%, indicates that every money generated in sales, they kept 0.6 cents as profit, while for DRB-HICOM, their net profit margin after tax is 0.4%. It shows that QL Resources have a higher net profit margin, which means that company generates more profits from its sales. Next, let's focus on liquidity ratio. Based on the calculation of the current ratio for DRB-HICOM Berhad, it shows that they get current ratio below than 1, which is 0.5, while QL Resources current ratio is greater than 1, which is 1.5 times. It means DRB-HICOM not firm enough resources to pay its debt over the next 12 months, while QL Resources is firm. For asset test ratio, QL Resources have higher amounts, which is 0.93, that indicates current short-term liquidity and position of the company than DRB-HICOM that only 0.5. DRB-HICOM have a lower amount of inventory turnover ratio, which is 4 times, that brings to sales are not strong and holding too much debt stock, compared to QL Resources that is only 5 times. QL Resources have lower stock turnover days, which is 72 days, than DRB-HICOM, 91 days. It means that QL Resources have the least debt stock in their hands compared to DRB-HICOM. Account receivables turnover ratios indicates a company's collection of accounts receivable is efficient, and the company has a high proportion of quality customers that pay their debts quickly. It shows that QL Resources have a higher receivable turnover ratio, 9.57 times, compared to DRB-HICOM, only 4.26 times. DRB-HICOM have a higher amount of account receivables turnover days, 86 days, than QL Resources, which is 38 days. It means that DRB-HICOM have a big problem paying their debt in short-term days. Account payable turnover ratio will be the indication that the company managing its debt and cash flow effectively, which clearly an advantage towards QL Resources because they are 8.88 times higher amount than DRB-HICOM, which is only 2 times only. QR resources have a lower account payable turnover days, which is 41 days, than DRB-HICOM 182 days, which shows that QR resources could settle their debt and cash flow in short time only compared to DRB-HICOM. For leverage ratio, based on the debt ratio, both companies have more assets than liabilities, but DRB-HICOM has a higher ratio, which is 76.53%. That indicates the company is riskier than QR resources at only 45.32%. DRB-HICOM is more burdened by debt expense as the company has the lower interest cover ratio, 1.16 times, than QR resources. QR resources has higher interest cover ratio, which is 5.15 times, so that company should be able to service its interest expense without any difficulty.
This part is about efficiency ratios. Okay, based on this slide, you can see that QR Resources has a higher earning per share (EPS), which means the company is more profitable enough to pay out more money to its shareholders than in DRB-HICOM, which has lower EPS. Then, high return on capital employed (ROCE) in QR Resources indicates more efficient use of capital than DRB-HICOM that has lower ratio of ROCE. QR Resources is earning more money on less investment than DRB-HICOM because the company has a higher return on assets (ROA). Furthermore, higher return on equity (ROE) in QR Resources indicates the company is increasing its profit generation without needing as much capital compared to DRB-HICOM, which has a falling ROE that shows less efficient usage of equity. Next, this part is about market ratios. As you can see, QR Resources has a lower price-to-earning ratio, which indicates the company's stock has more value than the competitor company, which is DRB-HICOM. Meanwhile, DRB-HICOM has higher price-to-earning ratio, which are generally taken as a company with bright future prospect for growth. QR Resources has value of market to book ratio more than 1, that indicates the management of the company has created value for its shareholders, whereas DRB-HICOM has a value that is less than 1, that may be taken to demonstrate that management has failed to create value for its shareholders.
Hi, I'm Chief Executive Zahiyah. Now let's continue with SWOT analysis. From the report, we can see that QR Resources' strengths are more high-yielding compared to DRB-HICOM Berhad, which QL has a compound annual after-tax profit growth rate of up to 20% and compound annual profit growth rate of up to 14%. If we invest more on QL, they have wider chance to broaden out their business, thus gain more profits as well as increasing the company's dividend for us investors. Also, QL has the opportunity of increasing their revenue with its 40,000 acres of oil palm planting business in Indonesia. We might recommend the company to increase the oil palm production by widening the planting lots there or buying new one here in Malaysia. Branching out into new revenue sources with having oil palm planting business here in Malaysia can reduce the operating expense, which include transportation costs and else. With reduced operating expenses, its sale and profit will increase, which will also bring us benefits. Okay, for QL's weakness, they have heavy reliance on the supply of the Indonesian, which also turns as a threat when the source faces shortage of seafood and unstable supply of livestock diseases, so as influenza risk. To solve this, QL can find a new valuable and reasonable source such as here in Malaysia or any other countries. Like the same concept as before, if QL can find a good source here in Malaysia, it will help to lessen the operating expense for the product, thus increase their revenues and profits. In contrast with DRB's weaknesses, It is far more riskier to take DRB up for investment, as DRB is having problems regarding the access to resources, which the company's manufacturing complex is very far from the defense and the industrial hub. Moreover, the material cost is not easy to produce, as it is hard to connect with the new permanent source with reasonable costs, referring to the kind of industry DRB is. The poor supply chain management in the forming of networks for sourcing raw materials and manufacturing products has led to a big impact, where DRB's sales revenue declines with more than 10% drop in total industry volume of vehicles sold in our country in the previous years. This has become a threat to the company. On the other hand, DRB also has the opportunity to grow its profit with new technology and innovative machines, as its requirements for new technology can save the cost of labor in production. Besides, they also have the chance to strengthen their manufacturing capabilities via strategic partnerships with foreign players to capitalize on their expertise.
As conclusion, the likely future general financial condition of both companies can be estimated from the current ratio and asset test ratio. QA Resources has current ratio more than 1, which is 1.52437 times. That indicates the company is more likely to pay the creditors back. Meanwhile, the DRB-HICOM has ratio 0.54714 times. That is below than 1, which means the DRB-HICOM may have problem in meeting its short-term debt. If you look at the asset test ratio, which is quick ratio, both companies have ratio below than 1. That indicates both companies may have difficulties to pay their liabilities on time. Furthermore, both companies surely have the ability to grow further their companies. The DRB-HICOM, which has price-to-earning ratio 55.07, is taken as company with bright future prospects for growth. Meanwhile, based on QL Resources efficiency ratios, we can see that the company is efficient in using the capital, as it has higher ROCE, that is 11.97%. ROE of QL Resources also shows that the company is increasing its profit without needing a lot of capital as much as the DRB-HICOM needs. So, to the board of directors, QL Resources Berhad is worth to be invested because it has a higher value of profitability ratios relative to the DRB-HICOM that indicates it is performing well. Besides, based on the overall results in liquidity and leverage ratios, it can be seen that QL Resources is more able to pay off its debt obligations. Furthermore, from the leverage ratio, QL Resources is more profitable to pay out more money to its shareholders, more efficient in using capital, earning more money on less investment, and increasing its profit generation without needing as much capital. That's all from us, and thank you for enjoying this presentation.